This video builds on the previous videos, and today we're going to be looking at what exactly should I invest in when it comes to shares or funds or unit trust or mutual funds or retirement funds, all these different words. What do they mean? So we said that the first thing we had to do is put in place the financial basics, that your income was more than your expenses and that your short-term debts were paid off. Then we needed to look at financial protection to make sure that for whatever reason, we were still able to have the income we needed should something go wrong. And financial protection makes sure that we're able to live the life we've worked so hard to achieve. Once you have those in place, then we need to start building financial independence and financial freedom. So in the previous lesson, we discussed how you should split your money. And we said that if you had spare money, that you should be saving 10% of your monthly expenses until you had roughly 3 to 6 months saved in an emergency fund. And that fund would be in a money market or income fund. Then we said that you would want to pay at least one extra mortgage payment a year. So you could divide that into 12 little bite-sized chunks so that every single year you paid one extra mortgage payment. And then what you wanted to do is make sure that you had a minimum of 20% of your pre-tax money was going towards long-term investments. And that this number should grow and grow and grow until you hit that minimum of 20%. So what do we do about our long-term investments and where should we invest that money? So the aim of investing is that the income from your job is slowly replaced by assets or investments that generate income. Now, an asset that generates income could be, for example, your house. So you might have an investment house, not the house you live in, an investment property, a rental flat, where you have a small amount of money that you've put in, and you might have a lot of money that the bank puts in. But that little rental flat will generate a rental income. And obviously, the more of that flat becomes yours, and the less is the bank's, then the more income you will get from that asset. And the aim is to grow lots of different types of assets or investments, such that they eventually generate an income that is equal to the income from your job. So that is the aim of investing. And when you hit that stage, you truly hit financial freedom, that ability to generate income from assets that enables you to stop working because it replaces the income from your job. Now, it doesn't mean that you actually draw that income every single year. What usually happens is you continue to invest the income that comes from your assets back into them. So, for example, you pay off that rental mortgage quicker. Or when it comes to investing in shares, you don't draw out the dividends, you actually buy more shares with that money. So what is a share? Essentially, when you buy a share, you buy a tiny little weeny piece of a business. Now, it's not physically, for example, if the business has 10 retail fashion stores, you're not buying a little piece of one fashion store. You are buying a share, a small piece of the entire business. Shares are also known as equities. So when you see something referred to as an equity, essentially that is a share or another name of a share. And what happens is that whilst you get a share of the business, you also get a share of the profit. And that share of the profit is called a dividend. And it's paid out usually at the end of a financial year. And sometimes it also gets paid in the middle of the financial year. So sometimes they'll say we're going to have an interim dividend, which is at half year. Now, obviously, the more profit a company makes, the higher the dividends will be. Now, what happens in a stock market or the market of all the shares is that the market creates the opportunity for lots of different businesses to trade the shares in their company. Because otherwise you'd have to go and track down every single human being that had a share in a company and do a sale between the two of you. So what the market does is that it creates the ability to buy and sell shares. It also, in order to organize the market, essentially what they do is they group the different shares into different types of what they call sectors. So, for example, different types of banks, different types of insurance companies, different types of investment companies would all be in a sector called financials. Different type of shops, be it clothing shops, be it food shops, would be in a sector called retailers. Different types of things that come out from the ground would be in a mining or resources sector. Technology, property, and many different sectors. What a market tries to do is to try and group similar businesses so that you can compare them within their group. For example, any form of financial share has a very different structure. So borrowing and lending money and investing money, there's no physical thing that you can touch. Whereas in mining or resources, there are physical mine shafts and there are physical things that mean that the financials or the business profitability and the things that drive business profitability is very different. So what they do is by grouping them in sectors, allow you to compare apples with apples and pears with pears. What it also enables us to do is to create what they call index. And an index is just the average of all of, for example, the companies in the financials sector would have a financials index. And property sector would have a property index. And all it is the average of the businesses there. Now, those average either happen in two ways. Either they say each business counts as one, or alternatively what they do is they say the sum of the share price or the sum of the price of all of that. So they either do what's called a value weighting or a volume weighting. And that gives us an index. Now, you can have indexes of different sectors. What you can also do is have indexes of the whole of a stock exchange. For example, in the UK, the index is called the FTSE because the stock exchange is called the FTSE. In South Africa, it's called the JSE index, all share index, and you have the S&P 500. Now, in all of those, you could have the top 40 shares in the JSE is called the JSE top 40. In the FTSE, they usually track the top 100 shares. So you can have little pieces of it or the whole big fat full market itself and track each of those. And all that it's doing is saying what is the average of all of those shares today. And what people ask is, was that more than yesterday or is it less than yesterday? Is it the market generally going down or is the market going up? And when people talk about what the market is essentially they're talking about an average of the basket of goods inside those markets. Then what happens is that you can have what's called an active fund. Now, instead of holding a fund that has every single share in it, what happens is that fund managers choose a basket of their own goods to achieve whatever the objective is that the people who are investing the money want. So if the people investing the money want a return of inflation plus 3%, the fund manager will choose different shares that he thinks together as a whole basket of goods will generate inflation plus 3. Now, when you buy a fund, you can buy it a bit similar to buying a share. So either in an active fund or in an index fund, you can buy one little piece of that fund. And it's exactly like buying a share. Every fund has a buy price and a sell price, and you can buy one of those funds. And essentially what you do is if the fund is divided into 1,000 pieces, each share will be 1/1000th of the whole value. And if you buy 10 of them, you'll have 10 1,000ths of the whole value. In America, funds are called mutual funds. In South Africa, can be called unit trusts, and in England, they're many times just referred to as funds. Now, there are many ways that you can access a market. So we said, to summarize, that you can have a single share, that you can buy an index fund that has any one of a number of different sectors, or you can buy a market index fund that has every single share on the market, or the top 40 or the top 100. And any of those index funds is what in the industry is called passive or index investing, because essentially you're not choosing one of the shares within that fund. You're just taking the whole average of the market. Now, the opposite of passive, or not the opposite, but an alternative strategy to passive or index investing is to buy an active fund. And each of them have different pros and cons. So with a share, if you know a company or an industry very well, then you might be able to do well in buying a single share. The challenge is, if you have insider information, you could be head up for insider trading. So you need to essentially be able to make a decision based on the facts that are available to everybody in the market. The con of a single share is that essentially if you put all your money into one share, your eggs are in one basket. And this often happens when people get shares in the company that they work for. And then they think that that company is magnificent and all of their money or all of their eggs go in one basket. And then that share crumbles. And their entire retirement is based on that one share. And whenever you have spectacular falls of companies, such as Enron, such as Steinhoff, such as there are just many of them, you will always hear with it people who've lost their whole life savings. So the challenge with a single share is putting all your eggs in one basket. And the other one is that it's very volatile. And all volatile means is that the price goes up and the price goes down very quickly and by large amounts. So one day you could be up a lot of money and the next day you could be down. Now, obviously, if you have 2 shares, you get the average of 2 shares. If you have 1,000 shares, you get the average of 1,000 shares. So the more you put into the basket, the less volatile it is. If you get it very right, you can do very well. And if you get it very wrong, you can lose everything. When it comes to an index fund, again, it's pros if you know an industry well. Or if you think, for example, that an industry has had some unfair press or unfair negativity and that it will do well. Then you're not betting on one single share in an industry. What you're betting in is basically that the tide, they call it the tide in investing. Is the tide coming in or is the tide going out? And when the tide comes in, everything goes up. And when the tide goes out, everything goes down. So essentially, if you think that the industry's tide is coming in, that it's all going to do well, then you choose that. And if one doesn't do well, it's okay because the other 10 did. Again, your eggs are quite concentrated, obviously not as much as a single share, but it's concentrated into an investment index or into a single index. And it can be quite volatile. It's obviously not as volatile as a single share, but it's also not as balanced as owning everything in the market. From a market index fund, you get the average of the whole market, which means that it is less risky than buying a single share or a single index. And it is also the lowest cost way to access because you don't need a huge amount of quantitative analysis and qualitative analysis to choose the right share. Over time, the market index usually consistently outperforms active funds, and that's why people get it, both for its low cost way and because over time, over a very, very long time, most active fund managers will never beat the market index. The con of it is that in theory, you only get average because the market index is the average of everything inside. Now, what's interesting is particularly as you go to bigger and bigger and bigger markets, like buying the world index, which is a basket of the funds inside the world, what happens there is that ironically, the MSCI World Index is in the top 25% of performers over the short, middle, and long-term range. And what's interesting about that is that theoretically it should only be average. But what it tells you is that active fund managers are underperforming it by us making such bad calls that it generally tends to trend in the top 25%. If you have a very much smaller market, such as the South African market, which is only 0.6% of the world's shares are in the South African market, then it tends to be a much closer average to average. But what is really important is that in small markets, you actually end up having concentration risk. So in a market like South Africa, there is a single share called Naspers, and Naspers has anywhere over 18% of the market at any one time. With active funds, it is usually that they do better in downward markets. So when the markets are running and everything is growing, they tend to struggle to outperform. But what often happens is that when markets are going down, they actually do outperform the average, the market index, because they have chosen shares that they believe will not be so badly impacted when the market drops. One of the cons of an active fund is that they might say that this fund has consistently performed for the last 15 years. But every time it gets a new fund manager, it is at risk of fundamentally changing the way it behaves. So past performance is not always an indicator of future performance when it comes to active fund managers. So one of the biggest things that one tracks if you're invested in active funds is what happens to the fund manager, because their decisions, their ability to hold themselves under stress is what is hugely important. And what happens is that you generally tend to get investment houses that are very process or procedural in the way they invest, and investment houses that are very person-centered. And essentially, you have more long-term stability over an investment house that has a strong processes and a strong investment methodology than you do over people-centered. But if you can pick the right person, and Warren Buffett himself thinks there are only 11 to 12 in the entire world that can consistently beat the market, then you will do exceptionally well. But I personally don't know the 11 to 12 that Warren Buffett knows. And so we're all stuck with the rest. And that means that it's very, very difficult to judge person-based investment strategies, which then makes it better to go with company-based investment strategies. Active funds are also much higher because there's a lot more research and a lot more analysis that goes into them. And essentially, the major thing that you have to consider when you buy an active fund is, has that fund produced in the top quartile or the top 25% for 5 years in a row or more? If they have, then it's a good bet or a good predictor that they may be able to continue, if the fund manager stays the same, of producing for the next 5 years or more. Don't look at 1 year, don't look at 3 year. For most funds, you need to be looking at their 5-year performance. And be very careful on the name of a fund. So when they say it's a balanced fund, that could mean that it has 60% shares and 40% bonds, or it can mean that it has 40% shares and 60% bonds. They are very, very different in their structures as to what's inside them. They're given these broad ranges of names because it helps to segment the market and it helps to compare. But for example, when you look at a flexible fund, all a flexible fund means is that it can do whatever it wants, which means that it could be 100% bonds or it could be 100% shares. It could be 100% local or it could be 100% offshore. So it's very, very difficult to understand apples and apples. You have to actually look inside it. But in our next video, I will show you how.